Let's welcome on board then and discuss markets further with Nilesh Shah. He joins in on the show right now. Nilesh, hi, good morning. Wondering, Nilesh, what to focus in on, whether it's the new variant, which the WHO as well has, sounded alarm bells against, and as to how that could lead to a fresh round of a global pandemic, or is it the market resilience, which completely seems to be shrugging off all the negative medical news?
As of today, market is discounting that vaccination will eventually overcome this pandemic. We have seen successful implementation of vaccination, allowing economies to open in US, UK, Israel, though there are also countries like Chile and Seychelles, where despite vaccination, cases have remained high. However, Seychelles and Chile have used Chinese vaccine majorly, and probably that's one of the reasons why they are facing an issue. So at this point of time, market is trying to ignore 3-month impact because of pandemic and hoping that vaccination will allow normalization of economic activities.
Yeah, seems to be the case. Nilesh, the other thing which is quite surprising is also what's happening within the broader end of the market. The way the small caps have been moving, the fact that, the BSE small cap in yesterday's trade managed to clock an all-time high already, almost 965 names out of the 3,000 which were traded yesterday were up more than 4% or more. 358 stocks already sitting at a fresh 52-week high. 70 stocks within the small cap universe are trading at their lifetime highs. What is that really telling you about whether or not one needs to tactically play this out, reduce exposure to perhaps large caps, increase small cap exposure, or is the time run out now to do all this juggling?
So there is an interesting thing about small cap index. I think it is still about 8% lower than Jan 2018 high, and yet market cap wise it is 30% higher than Jan 2018 market cap. This has primarily happened because of about 150 or 160 stocks in small cap index which have changed over last 2-3 years. Now, this kind of shows that from a valuation point of view, small cap today is fairly valued just like large cap and mid cap. 2019, 2020, partially they were undervalued, but now they are fairly valued just like broad market. So our call has been, you should be kind of neutral weight across large cap, mid cap and small cap. Build your portfolio on a bottom-up basis. Stay with less leveraged company, especially in small cap. Try to invest in companies where governance is reasonable. A bottom-up portfolio in small cap will be far more appropriate.
Nilesh, the other thing, of course, is earnings as well. Almost at the fag end of earnings, though a large chunk is still yet to be reported. What is it that you're making of the earnings commentary? The most often and common used word was second wave. The fact that there are margin pressure in a lot of pools, for instance, consumption, which has this new challenge of input cost pressures. Similar can be said about some of the auto majors as well. So on one hand, that's auguring well for metal majors. That's not quite good for, sectors which are actually consuming metals.
So by and large, March 21 quarterly results have been in line with expectation or ahead of expectation. The trend which we saw from September 20, where corporate results were coming reasonably ahead of analyst estimate, has continued in December. And because analysts upgraded their earnings, March 21 quarter on that enhanced earnings expectation is more or less in line. However, that is past. What people are interested is in future. And here, most management's commentary is that next 3 months we don't know. We'll have to wait for second wave and its impact. But thereafter, we believe business momentum will sustain. One experience of previous lockdown is that big becomes bigger companies which are large in size, companies which have access to capital, they continue to do well, and smaller companies suffer. By and large, listed entities are bigger in nature. They grab market share from smaller companies, unorganized sectors. So post-lockdown, they continue to deliver better return, or they continue to deliver better performance. So my feeling is that markets probably within a range will try to ignore second wave of infection. They'll continue to observe what is the impact on economic activities and corporate profitability. But at this level of market, it is still discounting that with vaccination, we will be able to overcome this pandemic.
Okay, fair enough. Nilesh, are you doing any kind of re-rating on certain pockets, financials? That's one area of concern. What's your outlook when it comes to that? Because there's so much uncertainty when it comes to the near term in really how the second wave will impact, things going forward.
Undoubtedly, there are certain pockets in financial services like microfinance, like commercial vehicle financing, like unsecured personal loans, which will get impacted far more adversely because of second wave. However, we have seen even after first lockdown that secured loans, housing loans, personal vehicle loans, SME loans courtesy the credit guarantee scheme of the government, and lending to large companies by and large were safe. One interesting observation over the last 9 months is that banks have started providing for COVID-related cost in provisions. And this has ensured that there is a reasonable build-up of provision in banks' balance sheet. If the second wave gets contained by vaccination, then yes, there will be pockets like microfinance, unsecured personal loans, commercial vehicle loans where there will be impact. But by and large, the bigger part of the balance sheet in terms of secured loans, auto, personal vehicle loans, housing loans, large company loans will be relatively better.
Okay, fair enough. Also, when it comes to certain pockets, particularly on the export front, IT, pharma, for instance, some of the domestic companies that are oriented more towards the global markets, there does seem to be expectation that we'll see further momentum build up here. Given the kind of highs, particularly in IT, that we're already seeing, how much more room for growth do you see?
So we believe, one, there is a broader call on the market. If COVID-19 continues to affect economic activities, then defensive sectors like IT, pharma, FMCG will do well. So there could be, let's say, in a very simple terms, a valuation re-rating in case of more uncertainty. On the other hand, if economic activity becomes normal, then cyclicals like metals and cement will do well compared to defensives. So this is one very top-down approach. But the second one, and which is more long-term, is that because of COVID-19, digital has been pushed onto the companies, onto the businesses. That has created much higher markets, much bigger markets for IT companies. And many of our IT companies have made investments into futuristic businesses like cloud, like data center, like artificial intelligence, like machine learning. And today they are able to service sitting in India like before, all over the world. Now, all this have created much higher growth visibility for Indian IT companies, and the valuation continues to remain favorable. One big advantage of IT companies, by and large, in entire industry, governance standards are fairly superior compared to other places. So put all these things together, we believe within the pack of defensives, IT should be able to outperform pharma and FMCG companies.
Nilesh, hi there, morning. Let's also understand your outlook on the auto space because, you know, it has continued to loom under the COVID shadow, as has every other sector. But, you know, there's a weak retail sales, the fact that there's rising commodity prices, a lot of supply disruptions, etc. And there has been that underperformance of the auto stocks as well for the most part of FY21. What is your sense as to how some of the auto companies can, overcome some of these disruptions and emerge stronger?
So for auto companies, the adage that problems doesn't come alone, they come in battalions seems to be working out. First, they faced chip shortages, then metal prices went up, and now finally demand is getting impacted. In all likelihood, auto sector is probably going to see on one side input pressure and on second side lowering of demand because of rising prices. Some of the auto companies have taken price rise to pass it on to the consumers, but that's probably going to impact the demand. So we do see auto companies facing a challenging time ahead. However, in terms of prices, a lot of bad news is already discounted. Now, in reality, what we have to see is going forward, how does the demand pick up? If volume increases to a great extent, your operating leverage will kick in for auto companies. In our opinion, we still believe two-wheeler companies, entry-level motor cars, these are the segments of auto sector where one can look at it. One can also look at those auto component companies which are applying for production-linked incentive schemes and trying to create a global supply chain management where they can become part to the global auto component suppliers. So there are some pockets within auto sector which one can look at. Some of the sectors which are avoidable will be more like commercial vehicles, more like high-end motor vehicles. So one will have to be very selective in auto sector.
Nilesh, curious as to how you're looking at the aviation space, only because of the fact that we just had an exclusive bit of information that Go Air is looking to file their IPO RHP this week. 3,500 crores is what they're looking. And what we understand, source-based, of course, is that the proceeds will be used for debt reduction. At a time when the sector is being weighed down quite heavily due to the COVID-related pressures, how are you looking at this move, and is there any view as to how you're approaching not just aviation but travel and hospitality as a whole?
So for many parts, early parts of my career, I believed in what one global investor talked about aviation sector, that if someone had shot down Wright brothers and aeroplane was not invested, career of so many fund managers would have been saved. That was by and large true for aviation sector, where they failed to create shareholder value for a long period of time. Obviously, times have changed. The same investor have invested into aviation sector. So we have also changed our view. In aviation sector today, there is a what I can call oligopoly kind of structure, where there is one very large dominant player, very efficient player, and then there are other small players. Now, right now, aviation sector is going through a very, very tough time. Air passenger traffic, because of second lockdown, has dropped from the lower base of first lockdown. Aviation companies are really struggling to make profit. However, if you see on a longer term basis, this oligopoly kind of situation in aviation sector will become even more tougher, and the leader will have disproportionate market share. So you have to really take a call how much short-term losses leader can suffer vis-a-vis what long-term potential is getting created for him. So if I have to invest in aviation sector, I will be only looking at the leaders. Rest of the players, one will have to be very, very careful investing.
Fair point. The other thing which is playing out in the market, Nilesh, is also, you know, agri-commodities. While we are hung up on tracking metals, what's happening in agri-space? I was just reading that corn is the latest commodity to pop up as prices have spiked up almost 50% in 2021 alone. We've already seen back home with what's happening with sugar prices as well. Do you think this is a theme? Given the cyclical nature wherein the best is yet to come?
So if we look at international agri-commodity cycle vis-a-vis domestic agri-commodity cycle, let's appreciate that while they move in similar direction, but they are not necessarily connected because of our restrictions and restrictions at other countries in terms of import and export of agriculture goods. There is no free flow of goods movement, and hence the local and global prices continue to remain at premium or discount to each other. Now, let me particularly take sugar sector. It was again a cyclical sector. Sugar prices used to go up, used to come down, and companies will continue to go up and down. Very few sugar companies created shareholder wealth over a longer period of time. Many of those companies, through leverage, ended up actually destroying shareholder value. Now, with ethanol blending, there is a fundamental change happening in the sugar companies' profitability. Ethanol will give them a kind of stability in their cash flow, and sugar prices will continue to be moving up and down in a cyclical manner, but that will be icing on the cake. Your bulk of the profit will continue to come from the ethanol on a steady state basis. Now, this is the transition of sugar company from cyclical stocks to structural stocks. Their volatility and profitability could come down dramatically, courtesy this ethanol blending. So when you enter into that kind of sector, which is moving from cyclical to structural, obviously PE gets re-rated, and that's where you will see a spurt in shareholder value or share prices.
Yeah, absolutely. That seems to be playing out already. Is that the same prognosis for metals as well, Nilesh? Is the best behind us? Or would you say that again, they are in a structural re-rating of sorts and the gains are here to stay?
So it's a really tough call, but I will put my money that metal continues to remain a cyclical story. The prices will go up. The consumers will find an alternate mechanism by replacing higher priced metals. Demand will fall. Marginal producers who were shutting their production will start making because prices have gone up and they have become viable. And eventually supply will increase and demand will come down and prices will fall. And the whole cycle will happen reverse way. So while there may be some rally left in the current metal cycle, I wouldn't say that metals prices will continue to remain higher forever or they are away from cyclicality. There will be cyclicality in metal prices. There is some rally left in the metal prices right now, but eventually law of nature will come into play. Demand will fall down because of higher prices. Supply will increase because of higher prices, and that will bring prices down.
Nilesh, what's your picture like when it comes to flows? We have seen the FI numbers go down a bit, especially, of late, whereas DIs remain fairly strong at this point. What's your outlook on the flows picture as it goes forward?
So from a mutual fund point of view, we have seen generally in the past that if there is a very strong rally, then during the first correction post that rally, generally mutual fund starts receiving flows. And what was happening in the past happened in this time also, where somewhere around second half of 2020, we started seeing redemption. And once the correction set in March and April and May, we started receiving flows. So in my opinion, we will see positive flows continuing. Number of SIP keeps on increasing in terms of quantum as well as value. Lump sum investors are also coming in through systematic transfer basis. So FY 2022 mutual funds should be a net buyer along with other domestic institutional investors like insurance companies and pension funds. When we speak to retail HNI investors, they are also looking to buy into this correction. Many people missed out the rally of last year, so they are looking to get into the market. There are people who want to increase their allocation to equity when the correction occurs. So by and large, on the domestic side, market should be supported from a flow point of view. On the FPI side, yes, in the month of April, we did see some selling. However, when we speak to our FPI clientele, they are observing India, and by and large, they are sharing the same view that with vaccination, India should be able to overcome current situation. So there may be some period where FPIs will be a seller, but over a period of time in rest of FY22, if with vaccination we bring COVID under control, they will be buyer in the correction.
All right, great. Nilesh, thanks so much for joining us this morning. Pleasure as always. Have a good day going ahead.